The amazing predictability of stock market returns. All right, this is nuts. I'm going to prove it to you right here. So remember, based on John Bogle and others, and this is what I learned from John Bogle, you can predict stock market returns with three things, two of which are predominant, the other one is kind of secondary. But the three things are dividend yield, current dividend yield, plus earnings growth year-over-year percentage earnings growth, and then on occasion you have appreciation because of an increase in PE ratios or a decrease in PE ratios will give you a little bit of a depreciation. But the bulk of stock, we're talking, the most significant portions of stock returns are earnings growth year-over-year plus dividend yield. I'm going to prove it to you right now. It's nuts. It's insane. Had a guy the other day, and I was like, dude, because last year the earnings growth was only 4% or something like that, and yet the market took off. I said, on any given year, we don't know. Any given year, the PE ratio could go through the roof or it could go down. It's not, any given year, you don't know. It's what happens is the longer term, 5-10 years, and I'll prove it to you. Right. Yesterday I did. So we're going to go over, I just lost my thing. We're going to go over a 10-year time frame from January 2010 to January 2020. That's 10 years of data. We're looking at the S&P 500, nothing international, no small caps. Yesterday I showed you the earnings, the dividend growth percent, and the dividend growth was up 10.29% on average. So annually it averaged 10.29%. Where it started, the dividend for the S&P 500 was $22.24 a share. So if you had one share of the S&P 500, you got $22.24 in 2010. That same share got you $58.74 at the end of 2019 or the beginning of 2020. So it went from $22.24 to $58.74, and doing nothing else. Just by buying dividend growing stocks, you would have increased your dividend by 250%. 10.29% annual increase by doing nothing else. It's nuts. Now the yield on the S&P 500 started in 1.98 in 2010, ended in 2020 at 1.79. Hasn't really done that much. We have a drop here in 2013 to 14, and the reason for that is because we had such a significant increase in the price. Usually when the dividend yield goes up, that means the prices go down. When the dividend yield goes down, that means the prices go up, all things equal. Sometimes you'll get an increase in dividend yield if they have a big payout, a big dividend that normally wasn't attributed, or they just really increased their dividend payout. But generally speaking, the dividend yield changes simply because of the price of the stock, or in this case the index. So a pretty significant drop in dividend yield when the price went from 1480 to 1822. An increase in dividend yield when the price dropped from 2028 to 1918 from 1.97 to 2.27. Actually, it's interesting because the dividend yield actually both grew. These things both paid more, the default in both these. So in 2015, the actual dividend was $39.9. In 2016, it was $43.55. So even though the dividend yield increased, there's more attributed to the price decline. Here in 2013, the dividend yield was $31.54. In 2014, the dividend yield was $35.40. And so even though the dividend yield dropped, the actual dividend itself increased. The reason it dropped the dividend yield is because the price went up significantly. All right. So remember, that's the dividend yield. So the first part of the relationship, the formula is dividend yield. So we're going to say 1.98 is our dividend yield over the last 10 years. Hasn't changed much. All right, now earnings growth. Yes, I showed you that the dividend yield went up by 10.29%, and I showed you the earnings growth, and here is the earnings growth year over year. So you can see 2010 to 11, it was up 45%. 2011 to 12, 11%. Down here, got hammered in 2015 to 16. Last year in 2019, it was only at 4.41, which is weird because the markets did so well. But yet in 2018, it was up 19.09 when the markets were actually down. So it's not like earnings growth happens in that exact year we have high returns. So there's a little bit of a lag and things of that nature. But for those of you who invested for the long term, you don't care if any one year doesn't matter. It's the 5 to 10 year time frame which really matters. So the earnings growth right here is averaged 10.81%. All right, so 10.81%, which is about double what I've predicted going forward. I predict about 5.5. So I predict a 2% dividend yield, a 5.5% earnings growth, and that why is I give the S&P 500 7.5% nominal, that's before inflation, return forward looking. So in any financial planning strategy I do, if you use my Right Capital software, I give the S&P 500 7.5 because I think 5.5% is actually more reasonable than what we had over the last decade. Who knows? But facts are we had 10.81% earnings growth, we had 1.98% dividend yield. All right, so if you add those two together, that should give us a return. Well, 10.18. Let's see here. That should give. I gotta get my trusty calculator. I thought I had it written down there. Maybe I didn't. All right, so we got 10.18 or 81, plus 1.98. That should give us 12.79%. That should give us a 12.79%, according to my formula and John Bogle and all the other guys, rate of return on the market. 12.79%. All right, now we also got to go take into consideration the change in PE. So the PE in 2010 was 20.72. The PE in 2010 was 20.72. The PE in 2020 was 23.36, which means it averaged a 1.19%. Is that? Let me just. That seems high to me. Let me just double check that here. So we take 10. Let me just make sure we got. Yeah. Okay. Good. 11N. We started 20.72 is our there. 23.6 there, and compute, 1.19%. All right. So the PE, 1.19. That's exactly, not annual, but the PE gives 1.19% change in terms of the price. So we were willing to pay $20.72 for $1 of earnings of the S&P 500 in 2010. We've actually are now willing to pay a little bit more than that in 2020, and you can make a reason for that because of the lower bond yields. It frankly doesn't matter. We have less of a worry about the Great Recession behind us. Anyway, the PE has gone up a little bit. So the PE has gone up by 1.19. So the equation, the formula, which is dividend yield plus earnings growth plus PE plus or minus. All right, so here we got dividend yield 1.98, earnings growth 10.81 plus 1.19, which gives us 1.19, 12.79 plus 1.19, 13.98% is our return. So 0.98%, 0.98. So we can, with all those three things right there, 13.98. So according to the formula, the S&P 500, if you would have invested in January 2010, it would have given you 13.98% a year over the last 10 years. What actually did the S&P 500 do, though? It did, what, you ready? You want to take a guess? Put thumbs up if you get anywhere near this, thumbs down if you don't. It's okay. 13.52. That's what it did. So 13.52. We were off by 46 basis points, less than 0.5%. The S&P 500 over that time frame gave you 13.52% a year. Our formula said you should have got 13.98% a year. But that's actually fleeting because this right here, if we would have done this in the year before, the S&P 5, the PE ratio would have been down. But still, you can see the price to earnings gives you a tiny slither of returns. But look at that. I mean, 13.52 is what we predicted, as what the S&P 500 did. We predicted 13.98. And again, we don't ever predict what the PE ratio will be because we have no idea. But if you just take the dividend growth, earnings growth plus dividend yield, we're getting 12.79. S&P 500 is 13%, 13.52. We were between 0.5 and 0.75 of 1 percentage point over those 10-year time frame. Pretty doggone fancy. Now the issue is, people say, well, but yeah, look, you only got 4.41% in 2009. Earnings growth with a 1.79 in 2019, but the market is up 30%. Again, we're down in 2018 we got 19% earnings growth because it doesn't happen in one fell swoop. I mean, it takes time to settle in, it takes time to realize it. My guesstimate would this be a negative year or lower returning year because the earnings growth were so poor. Because earnings growth is usually a prediction of the future, not necessarily hindsight for the back. But I mean, it could be. Maybe the the negative return in 2018 was attributed to the future looking of earnings growth. I mean, I don't know. Either way, usually when you have a bad earnings growth like that, and that's not even a bad earnings growth. 4.41 is not negative. Here's negative. 2016, when did the market go down in the last? Actually, I don't think I have it here. I don't have the S&P 500 returns. But anyway, you'd expect to see a negative year probably the year after this. So if 2015 to 16 earnings growth are down by 14%, you would probably expect to see a negative year in 2017 or something like that. I mean, there's no science to this. This isn't scientific, but it's just it's easy. You said earnings growth year over year plus dividend yield. I mean, it's literally that simple, and there you go. Some years have insane earnings growth. Well, you didn't get 44% return in 2011, but it levels out according to earnings growth plus dividend yield. It's really that simple. Oh, by the way, I want to tell you what the 10-year Treasury is doing. Up here is 3.85. Went to 3.38, 1.97, 1.86, 3, 2.12, 2.24, 2.45, 2.46, 2.66, and now at 1.88. Actually, right now it's at 1.13, which is insane. So what happens is you always have to look at competing investment assets. Where can you put your dollar bill? In this case, you can put your dollar bill in 10-year Treasury, or you can put stocks. And because this 10-year Treasury is so poor, even relative to the dividend yield, the 10-year Treasury is secondhand news. I hope this helps. Love to hear your comments on this. All right, we'll see you.